Welcome to The Pitch. I'm Huxley of Livewire Markets, and joining me today is Nick Raphaely, co-CEO and co-founder at AltX. And as you're about to find out in this episode, Nick is no stranger to funds management, nor for that matter, setting up your own business from scratch. And we're going to find out how all that has influenced his investing journey today. Nick, welcome.
Thank you very much. Nice to be here.
I mentioned that you've got quite a long background. You completed your undergraduate degree in South Africa, went to do further education at two of the most prestigious schools in the world, Cambridge and Wharton at the University of Pennsylvania. I'm curious, with all of that academic experience, if you like, what was the most valuable lesson you learned at both of those institutions that you are still using in your business life today?
So I think it's an interesting question, and when I reflect on my academic journey and I guess how it's impacted my ability to be involved in starting and building a business, I think that what I learned at university gave me a very good base framework. So I studied both finance and law, and if you think about what we do in our business, we're in the lending business. So it's a combination of understanding the numbers, what rate are you lending at, how does the math of the various fees and interest rates work. And then there's a legal aspect, how are you contracting with your borrower, how are you funding yourselves with investors, what are the contracts that support the underlying loan transaction. So I think having studied both finance and law, that gave me a really good base to understand and I guess have a springboard into what I'm doing. But I think when I reflect on kind of what life in academia is like as compared to the real world in building a business, I think in academia, you get rewarded for excellence and purely for excellence. Once you step out into the business world, what you quickly realize is that it's much, much more open. There's a broad framework of rules, but there's so much scope and so much latitude to do things in your own way, to put your own footprint on it. But there's no guidebook as to how to do it either. You're in an environment where things are changing all the time. No one can tell you what's right and what's wrong. It's trial and error. You're learning about yourself, you're learning about the environment. In my case, I came to Australia as a new immigrant in the early 2000s. I was learning about Australia too. So I definitely brought with me, from an academic perspective, the core skills. But it's almost like once you step onto the field, it's like, okay, you know how to catch the ball, but what's going on, what are the conditions like, what's the opposition doing, how are you feeling, which way is the wind blowing, is it going to rain? You've got all these factors playing into it, and you've got to find your way to the goal line. And like that's I think one of the most exciting aspects of business is the fact that it is so open and unstructured, but at the same time you get to bring your core skills to the party.
Let's talk about finding your way to that goal line then. You've been setting up firms consistently since 2005. So I'm curious, with all that you've just said, what are the best and worst parts of being a founder in funds management?
Yeah. So it's interesting. I actually began my business career after I finished university in corporate. So I joined a company called Merrill Lynch. They don't exist anymore, but they were one of the investment banks of the day in kind of the late 90s and early 2000s, I think subsequently taken over by Bank of America. And I kind of viewed that as a good opportunity to be in a training ground and to kind of, learn how business works and kind of learn best practice in structuring and modeling and negotiation and being part of a team and various things. And I think that gave me a really good foundation. But I think once I left there, I kind of realized that the difference between big business and small business is really, really different. And I'll give you an example. So if you want to make a decision in a big company, what happens? 3 or 4 people get in a room, you discuss it, everybody kind of gives their point of view, but everybody's a little bit guarded because nobody wants to stick their neck out. And then you probably try and reach an answer by consensus, some emails may follow, and you broadly move in a direction. But if anything goes wrong, nobody wants their stamp on it because they have to own it. So decisions happen very collaboratively and very slowly. In small business, you'd be dead in the water if you had to take that long to take decisions. So you're taking decisions instantaneously, in real time, as things are happening. And if they're wrong, you're going to fix them and change them. So I think that big business will give you certain structure. But coming back to what I was saying at the beginning, once you're in business and you're in business for yourself, you've got to figure it out on the go as you're going.
Yeah, no, absolutely. How did you deal with the period from 2021 through, end of 2022, 2023, when rates went up 425 basis points, often in massive increments in one go?
So it's a really good question. We've lent almost $5 billion, and we've done that without any loss of capital, and we've always paid 100% of interest owed to investors. So we're able to point to a very strong track record. Now, some of our detractors would have said in the early years, but you guys lent into a very benign environment. You started the business rates went down, assets went up. Like, yeah, a blind Freddie could have done this without losing money. You know, there's nothing so special about you guys. But then things changed, right? We had a small market correction in 2018, 2019. Then came COVID, where things basically jammed up altogether. And then came the rate rises, where rates shot up, asset values corrected. So we've had to trade through different environments, and I think that's really put the robustness of the model to test, where we've had to show that our underwriting, our credit, our assessment of collateral has been able to weather different environments, and it's been difficult. It's been a much more tricky process to assess collateral values in a moving environment. But as I said, the business has been able to maintain the track record, and I think has done very well.
Based on your experience, you are probably the perfect person to then ask this question. What are the kinds of opportunities which interest you the most, and what is one example of such an investment you've made?
So I think construction funding is an area where we see massive opportunity, because I think there's a bit of a disconnect there between the way that the investor capital sees it and what the actual risk is. So just to unpack that a bit, we do ground up construction funding, first mortgage. So what that means is we'll provide loans from say $3 million up to $40 million to developers for projects. The sort of things that we're building, think about small blocks of apartments, townhouses, luxury houses, duplexes. So we're not doing like really, really bitty pieces or bitty builds, and we're not doing massive high rises either, like 40-story buildings. We kind of like that space in the middle, because we feel that those are projects of a size and a scope where if anything went wrong, we'd be able to send our team in to finish them operationally, and also we'd be able to muster the financial resources to get the projects done. So as a business, we're set up with a civil engineer, 2 qualified builders, someone with a quantity surveying background as part of our construction funding team. So we take a very hands-on approach. So I think we can execute that part of funding really well. I think it's a huge opportunity for investors who see value in that and are prepared to provide capital to a player who understands and can manage that risk. It's a little bit more involved than kind of your plain vanilla, give some money, give or borrow money secured against a house or a unit, which is finished stock. You're funding you're effectively in partnership with the developer, because you're funding them through the build process. But if it's managed well, I think you can extract a good margin, and I think it can be very fruitful for investors as well.
Well then, as you would know as an entrepreneur, if you want to be in business, you've got to be able to do something different, right?
Exactly right.
Nick Raphaely, thank you very much.
Thanks,
and thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Market Index websites as well as our YouTube channel, where you can catch more episodes of The Pitch. We'll see you next time.